So look at that question. We have a company, Horitch Limited. So they gave us the standard. That's they said it takes 0.5 hours per unit to produce the product, right? And the price, which is the standard price of labor, is $12 per hour. We have that. Now, we've been told that the standard should be revised to reflect that the production process has changed. So in this question, the process has changed within the year. And this has led to a reduced need for labor input by 20%. So what does that mean to start with? If the need for labor has been reduced by 20%, what does that mean? So it means that the time that is going to be required to make one unit has been reduced by 20%. So which means that when we are preparing our revised budget, how long will it take to prepare one unit? So that means the process has changed. What we planned, our plan was that it's going to take 0.5 hours per unit. That was the budget. So what we have here is actually the budget, the old budget, beginning of the year. But we're told now that we won't be needing 0.5 hours to produce one unit because there's a reduction of 20%. So we're only going to need 80% of that plan, which is 0.4. Okay, nice. At the same time, the process now needs labor to be of a higher skill level at a higher rate of 14%. So which means that even the price of labor has changed. From the budget of $12, is now going to be $14 per hour to pay labor. So which means step one is to prepare our revised budget. Revised budget in the sense that we need to know the revised rates and the revised hours. So what's our revised rate now?
$14.
Yeah. So this is $14 per hour. And revised hour will be 80% of 0.5, which was how you got 0.4 hours per unit. Because 20% reduction, 20% of 0.5 is 0.1, 0.5 minus 0.1, still 0.4. Yeah, if you look at it like that. So we have our revised budget. We're good. We're good. So the next thing we need to do is step 2, which is to get our planning variance. And we know that planning variance is about budget, the old budget versus revised budget. So what we are saying is that revised budget will be serving like the way we used to see actual. Yeah. So our revised budget is almost like our actual. That's what we're saying. But it's not actual, but I'm saying look at it like that. Because we're saying that this is our plan and this is what we are having now. Right. So if we want to do rates, let's start from the rate. So rate variance. So we're going to do both rate and efficiency. Remember, for labor, it's combination of rate and efficiency. So though they are planning variances, but we still need to do the rate variance. So rate variance is about price. Did we pay those labor a different rate than we plan to pay? So they have worked for some hours. The rate variance is that did we pay them at a different rate from plan? So what did we plan to pay? We plan to pay, old budget was 12. But eventually revised budget is 14. That's what we're saying, right? So which means our variance is 12 minus 14. Or if you always want to put actual in front, whatever, I'm not fixed on whichever you want to put in front, right? But maybe to make things consistent for you, whenever you are doing your practice, whatever you see as your actual, put it in front so that whatever you have as answer, you can also interpret easily. But whichever way, it doesn't stop you from getting your answer. What is important is get your figure and get your interpretation right, actual, favorable or adverse. So if revise is 14 and we planned 12 before, yeah, which is in the question here, yeah, budget, yeah. For those hours that they worked for. However, remember, this is a revised budget that we are looking at as actual. So we're going to be using the revised hours, not actual hours, because in planning variance, our revised budget is in quotes, our actual. So, and what would be the revised hours? That would be 0.4 multiplied by how many units output? So it takes 0.4 unit, 0.4 hour per unit. So that means times 80,000. And that would be 2 multiplied by, what's 0.4? That's 32, right? 32,000. And that's 64,000. Yeah. And like I said, if your revised is seen as actual, it means that your budget was better. So your price has gone up in reality because the old budget is less recent. The revised budget is the new reality. So this is an adverse variance because the reality is now more expensive than where we used to be. Our revised budget is the new reality. These are our new reality. That is why it is seen in quotes like you're talking about the actual. So what you are saying is that you planned for 12, but your new reality is telling you that it should be 14. So which means you're actually in an adverse state already. That's rate variance, and that is planning variance for rate. Is it clear? Good? Because I thought you look a bit confused at the point.
No, it's clear, don't worry.
Okay. Now the same, still on planning variance, we have to do same thing for efficiency. For efficiency, yeah. And for efficiency, remember, what did I tell you? Whenever you hear efficiency, what are we talking about?
Hours spent.
Hours. So we're talking about hours. So now it's about quantity now, it's about hours. And in English, normally what do we say? Fantastic. So it's about number of hours that we worked versus the number of hours that we planned. So did we work more than we planned to work? And valuation will always be done at a standard, not at actual. Remember, anytime you're talking about valuation, pricing is always at standard. But when you are multiplying by quantity, it's always actual quantity. In any variance formula you will see. Well, that's another way to help you solidify even your understanding in English. Because once you start writing in words and you're putting it down in formula, you see that you are consistent with it. So which means efficiency here is about the budget quantity, budget hours versus the revised hours. Yeah. And you're definitely going to value it at the standard rate. And your standard rate is your budget rate because that will now serve as a standard. Remember what I told you? You always see your revised budget as your actual in this circumstance. Right. Right. So let's compare the budget hours and the revised hours. So revised hours, we already got it as 32. So we did that before. So 32,000. Always like to put actual in front minus budget hours. Budget hours will be at 0.5 for 80,000 units. That is 40,000. 0.5 times 80,000. Then we're going to value it at standard rate. And what's our standard rate?
12.
12. Fantastic. 12. So that means we have 8,000 times 12. And that's 96,000. Favorable or adverse? Because it's important. I always like to ask because If you don't understand, you will also struggle to know whether it's favorable or adverse.
Why did we use 12 instead of 14? I didn't get
14 is
that one.
14 is not standard rates.
It's the actual one.
14, it will be like actual. I've told you, you never do valuation at actual price.
Okay.
And when you're comparing in planning variance, your revised budget is standing like an actual for you,
Okay.
right? So your standard is your budget. The new reality is the revised budget, which is like a fresh actual. Though not an actual, but in this circumstance of planning variance, see it as an actual, because it's the one that is more recent compared to the previous budget. You know, your actual is always the most recent. So when you're comparing two data, the recent data is like the actual because it's better or it's more recent, reflects reality than the old one. Okay, so 96,000 favorable or adverse?
Yeah, it's favorable then. So that means we use less time.
Exactly. Yeah, so once you are doing your planning variance, please use your revised budget as if it's actual, so that you can stay consistent with the understanding that you've always had. Make sense? So that means it's 96,000 favorable, and that is planning variance. So, which means we can now do operational variance, which is what we will use to do the appraisal. Now it's time to know whether the manager has done well or has done poorly. Now let's find out. When we're dealing with operational variance, we said our revised budgets will be our standard, and we'll now compare with almighty actual. Now this is time to measure performance. And we're going to do the same thing for rate and efficiency. So let's do for rate. Can you guys do for rate for me? What do you have? Let's do it together. What do you have for rate? Rate variance for operational variance. First of all, who says it in English for us? Let's see. We need to keep testing on that understanding. Usman, do you want to try to say it in English for rate? Not necessarily for operational variance, but generally for rate. Rate variance.
Have we paid more or less than the standard or the plan?
Exactly. For those hours worked, have we paid a different rate other than what we planned for? Yeah, which could be less or more. But have we paid at a different rate? Because we're talking about rate variance. Fantastic. So for rate, we've said that rate is about paying different rate than plan, other than plan, right? So the question is, have we paid a different rate from what we planned for those hours that those labor guys worked for? So, and we know they worked for 33,000 hours, which is the actual hours. But the question is, did we pay at a different rate, right? So the rate that we plan is the revised budget, which is now 14, right? And let me put it according to the formula so you don't get confused. Yeah. So standard is 14, which is what we planned for. But how much did we actually pay? We paid at the rate of 447 divided by 33K. So 447,500 divided by 33,000. And this is what gave you 13.56 minus 14 times 33K. That gives that variance that you have of 14,500. And definitely this is favorable because this is actual is less than the plan, right? That is rate variance planning. I'm your operational. Now we're still doing the second one, which is efficiency. What I say about efficiency is that anytime you hear efficiency, think about the hours consumed, because you are more efficient when you spend less time on whatever you're doing. So how efficient are we? It's about number of hours that we used. So we are saying that did we use more hours or less hours than we should have used? Yeah, so which means we're going to have actual hours minus the standard hours then I said our valuation will always be at standard price. So this time around, standard rate. So if we are comparing revised budget and actual, definitely this is our standard. So actual hours, 33,000. Revised hours, which is standard hours, is supposed to be at 0.4 times 80,000. Then the rate is the standard rate, which is now 14. So that is 33,000 minus 32,000 times 14, and that is 14,000. So we are using more hours than we should have used, and that is adverse. Because when we consume more hours than we should have consumed, it's bad. We're going to pay more. So from this now, we are expected to tell whether the production manager has done well or badly. What do you guys think? Has it done well? Looking at our planning variance and operation variance. So let's even try and summarize it. So let's see planning and operational for both rate and efficiency so that we can talk about it. So for planning, rate and efficiency, we got what do we get for rate? Rate 64,000 adverse. Then operation rate 14,500 favorable. And 14,000 adverse. So net operation and planning, we can even say, so here we have net of how much? 96 minus 64. That's 32, right? That's 32,000 favorable net. And this one net is 500 favorable.
Yeah.
Looking at this scenario, do you see the advantage of planning and operational variance already? Let me ask you, has this guy done well? Has he done very well or has he done badly? If I say, let's try and rank his performance. Let's say the performance appraiser is good. Maybe very good is the best, then good, then you have bad and very bad. How do you appraise this production manager?
So good.
Good as well, because he tried.
Okay, try.
I'd
Yes,
say
yeah.
good as well.
Good as well. Remember, the question says you should prepare. That is one part of the question. So you can prepare and do all this calculation. If you don't understand it, you can't even analyze it. Because this assessment, whether the purchasing manager or operation manager individually have done good or bad job, that might actually take another half of the marks. Which is that explanation I'm making. Because here, we don't have any business with the purchasing manager. Because this is production hours, labor hours. So we're going to be talking about production manager here. And the way you've analyzed it, fantastic. Because imagine, without this breaking down, we would have been given 32,000 favorable praise to this production manager. Whereas what we have seen is that 32,000 favorable is not for him. That is coming from planning. Things that change that are totally outside his control. Gave him 32,000 favorable. So the only effort that contributed to our outcome was just an outcome of 500 favorable, very small. So which means we'll not call him a bad guy because we are not adverse, but at the same time, he's not any exceptional. He is just okay. So he's good. And I totally agree. I align with you guys. He's just a good production manager because he didn't give us 32,000. He only gave us 500 favorable. Only time and chance gave us 32,000 favorable. And that is the essence of doing planning and operation variances. Because we're able to separate chances from efforts. We're able to separate controllable factors from uncontrollable factors. And that is it. But let me just quickly mention examples of changes that can trigger revision of budget. Let me put it like that. Remember, like I said, only senior managers should change the budget, which means it's not all the time that you just sit down and just be changing the budget. It has to be, there's criteria that have to be met. Yeah. The first thing you need to understand is that it has to be a significant change. Yeah. And that significant change, you must have evidence that it is, or it cannot be anticipated. Let me put it again. It cannot be anticipated. Remember, because if at the beginning of the year you should have anticipated that change, then you should have put it in your plan. So you are saying that this kind of change cannot be anticipated, so we couldn't have been able to plan for it. Maybe it's a new policy, it's a new law that is coming that now requires you to spend more. Maybe it's a natural disaster, like maybe it's a COVID, something like that. Maybe a supplier is being liquidated and you couldn't have anticipated that, or you didn't see any sign. Then you can make changes to the budget, but still you can't make it as a manager. Senior managers have to make, bosses have to make those changes. Yeah, and that is the only reason why you need to consider revising your budget. Okay,